Hi, my name is Gabriel Mora, and I'm here with Akshat Juneja. We're both students at the University of Pennsylvania, and today we're going to be discussing a proposal for a strategic transaction at Altus USA. A bit more about this company. This is a media and telecommunications firm that has completely underperformed relative to its peers, as well as the S&P. This is mainly driven due to NOPAT margin compression as a result of increasing OpEx over the last 5 years, as well as slowing capital intensity, which has led to diminished ROIC figures. This, coupled with the declining year-over-year revenue growth, has led to a hazy picture at Altus USA. And moving on from there, what we've been able to see at Altus USA is that because of their high OpEx, predominantly that is mainly due to high levels of DNA. This high levels of DNA is due to large amounts of CapEx being spent due to their shift to fiber optics overall. And this, coupled with slow revenue growth, has led to value destruction, as outlined in our next slide. So in this slide, we do a DCF analysis where we discuss the implied equity value, the price per share, as well as our implied TEV. What we see here is the implied TEV is 5.4 billion and the implied equity value is 20 billion. At this implied TEV, all the liabilities of the firm are not able to be covered. Therefore, this is a balance sheet insolvent firm. And additionally, with the 7.4 billion debt maturity wall likely to come up in 2027, we believe that there's potential cash insolvency risks in the future. And ultimately, we think Altus USA is not a bad company as it relates to their hard assets, but more so that have had a large amount of leverage that is unnecessary for a business of this kind, as we can see with the high net debt to EBITDA compared to peers. This has ultimately led to a higher cost of debt and WACC. And given that their current returns or ROIC is less than this WACC, we believe that Altus USA needs to be more cautious moving forward as it relates to their investments. So here in this presentation, we're going to advise on potentially some capital market transactions, a potential operational roadmap to ensure that they can move in a value creation path.
So essentially, to understand the debt structure, there's two main debt silos to understand from very high level. There's CSC Holdings, which is a core operating and financing entity, and below that is Cablevision Lightpath, which I'll refer to as Lightpath from here on. Lightpath is structurally subordinated to CSC Holdings, and some comments on guarantees and lien architecture. Lightpath debt is secured only by Lightpath assets with no recourse to CSC. CSC owns Lightpath equity but cannot pledge Lightpath operating assets to secure CSC debt. In terms of unrestricted subs, restricted subs must guarantee CSC notes and grant liens. However, unrestricted subs, including Lightpath, are excluded from CSC guarantees, creating potential collateral pool for an ABS transaction. And this is something we'll exploit later on in the presentation. In terms of the waterfall priority orders given below, just quickly pointing out the CSC senior unguaranteed notes are Pari Passu, and we offer pro rata recovery in some of our waterfalls later on.
When diagnosing the causes of ROIC erosion and paths for recovery, we ended up stripping out DNA and noticed that relative to their peers, their EBITDA margin profile is actually broadly in line with all these other companies at 37.1.5%. This implies that their ROIC issue is more so one of capital turnover and efficiency. And looking at their asset turnover ratio, Altus USA currently sits at 0.28%, which is much less than the rest of their peers. This is again due to the high amounts of CapEx relative to revenue growth. We have three operating suggestions to improve their ROIC figures. One is the slow and resequencing fiber to home build out. Two is divesting and leasing back non-core network assets. And three is consolidating and rationalizing their legacy infrastructure and transport layers. Further analysis is there on the slides.
Here's our return on invested capital, and here we show the cost of debt and the weighted average cost of capital. We're essentially sensitizing it using the cost of debt and WACC, and evidently the WACC is highly correlated with the cost of debt. But our general thesis here is that we can experience significant ROIC uplift over time as the cost of debt goes down. A couple quick reminders, about 73% of the debt is fixed rate, and we believe as we refi the B5 and B6 term loans, in a lower rate environment, we can essentially bring down the cost of debt. This is floating rate debt over time, and this will essentially give an uplift to our ROIC figures and our DCF valuation. Furthermore, the unsecured swap should also provide an uplift, and we'll go into this later in detail.
Moving on to different valuation methods, we believe that at $2 per share, the market is currently reflecting optimism on Altus USA's path to value, as mentioned in the prior slide, or potentially a successful out-of-court transaction. When looking at median trading comparables, that's currently EV to EBITDA 6, and the mean is 8.15. If we apply this 8.15 to Altus USA current EBITDA, it would imply a total enterprise value of 26 billion and a share price of $2.40. This is roughly in line with the current price today. Precedent transactions are potentially also being used to value this business by the market. Perhaps they think that Altus USA is due for a potential sale, and given the 7x to 12x EBITDA figures, $2 per share is sensible.
Here we show our liquidation valuation. The assumptions are there on the screen. We've used pretty conservative percent recoveries, and especially for the cable franchises, we've given it a decently high recovery in the 25 to 50% range. Quick claim, we're pricing in 28% secured claims recovery in our low recovery scenario, and in the high case, 74% recovery. This is essentially to show that the company is worth significantly more as a going concern once we implement our strategic out-of-court transactions combined with the operational improvements proposed by Gabe. Now moving on to our waterfall here, we show that the fulcrum tends to be the CSC unsecured unguaranteed notes, but for our DCF, the intrinsic case, the fulcrum is a 58% secured notes recovery, and further detail is provided in the appendix. Now coming to our out-of-court transaction plan. So we're essentially proposing a three-part solution. First is a drop-down in an ABS transaction, which I'll go in detail under the next slide. The second is a structured unsecured exchange, which I'll explain here. And the third is a discounted buyback of the 2030 and 31 maturities. So right now, as shown in the red, the 30 and 31 maturities are trading at a roughly 35 cents a dollar. I believe that this is a key moment to capture steep discount and delever, and they can deploy their ABS proceeds from the LightPath dropdown ABS transaction and internal cash that they've recently gained in Q3 25 from major non-core asset sales. Trading at steep discounts, capturing this, they can lower interest expense significantly in 26 to 29. Next, a distress exchange for the 2028 maturities. First, quickly touching on a lot of the 7.4 billion in the maturities is driven by the term loan and the RCF coming due in 25 27, the B5 term loan. This can be refied. Currently, it's trading at around 94 cents on the dollar, 94.50, and the market by this price is telling us that a refi is highly likely and highly possible. So this is a given refi, given its current state and significant cushion beneath it. Second, we're proposing the 5.5% 27, 5.375% 28s, and the 11% 28s. We're offering them par accretion to par and 95s for the 11% due 28. And we're also providing them potentially a warrant consideration to align incentives. And this unsecured exchange has been done previously, Frontier serving as our precedent. And this will allow us to push maturities out 2 years and also help with the debt burden. The third and the most important is exploring unencumbered assets. And here we have to just think about the LightPath debt silo a bit more. So Cablevision LightPath, which I'll refer to as LightPath, is a major opco with main fiber assets that sit at this entity. On July 3rd, 25, there was an internal reorganization petition where they created a new sub called LightPath Fiber Infrastructure for an ABS transaction, roughly around $2.8 billion. And essentially, the firm has CPCN assets in 14 states. We have shown footnote 3, the quote here on the slide, and the asset transfer information from the actual document. And this transaction actually leaves 6 residual states, which we've also outlined here, still at the LightPath OpCo entity. So we are proposing creating a new SPV, bankruptcy remote SPV, calling it LightPath Fiber Infrastructure 2, shown in red in the org chart. And we plan on transferring the residual 6 state fiber assets here. One quick thing, a note. The LTV on fiber assets is significantly higher than HFC, which are hybrid fiber, because the fiber is just a newer technology. Hybrid is going obsolete over time. So therefore, the LTV is around 60 to 70%. So we can raise significantly more incremental ABS capacity. Of analyst estimates and rough calculations, we believe this is 1.5 to 2x a July proposal. So that gives us a range between 4.2 to 5 billion. This severely helps with the 27 maturities. Now, looking at all the transactions we propose, LightPath ABS gives us about 4 to 5 billion. The buyback delevers around 1.8 billion and saves a lot in interest expense. The unsecured swap in the refi of the 27 gives us a rough capacity creation between 6 to 7 billion, very rough estimates, and this is how we deal with the 27 maturities. So we have shown how this company is worth more as a going concern. And